I was looking at the list of speakers today, and I can tell you you're going to get a treat. And the reason why you'll get a treat is because the names that I saw, they run the whole gamut from bottom feeders to those who buy the best companies. And that is what you want in a conference. And you will see with the Benjamin Graham principles, whether you buy good companies or you buy crappy companies, as long as you apply the principles properly, they all work. And so the question is, where can you apply Benjamin Graham principles other than in investments? So one area that you can apply is in insurance. So this is, let me show you what I did with this insurance company. So this was in May of 2017. I was alerted to the fact that Stonetrust was available, that I could buy it. So I went and looked at the 2016 balance sheet. And what I was looking for was the ratio of investable assets to shareholders' equity. And if there's a 2-to-1 ratio, then it makes my life easier in terms of compounding money. So if you look on this balance sheet for Stonetrust that I'm showing it to you, the one in yellow, so investable assets was 128 million, and shareholders' equity was 52 million, and the ratio was 2.47. So that would mean that if I make 5% return on investments, I would be making more than 10% on shareholders' equity. And if I make 7%, then I'm making more than 15% return on equity. So that was what you call the attraction, the big attraction. And so I was able to buy it, on January 1st of 2018. And in a couple of years, COVID hit, and that gave me an opportunity to be able to buy bonds and stocks at a really discounted price. As you know, in investment, you're looking for mispricing. And that is very similar to what I do also in insurance. I'm also looking for mispricing. So in this one, in Stonetrust, if you look at it, the first mispricing came when COVID hit was in the fixed income securities. Now, other insurance companies were playing something called, just buy the T-bills, and they were giving you only 10 basis points. You can hardly make any money on that. I totally rejected that approach. When the time came and I found bonds that were really cheap, I bought them. And you can see Benjamin Graham principles work even on bonds, on fixed incomes. And whether I buy junk bonds or buy investable grade bonds, they will work as long as you buy them cheap. So you can see, just to give an example, this portfolio that I had in the first quarter of 2021, like Ontario Resources. No, I bought it at 43. The bond price at the end of the quarter was $67. And this portfolio that I'm showing you is not just the winners. This was the whole fixed income securities of Stonetrust. And the big hit was Athabasca. I bought it at 22 cents, but I had a coupon of 9.875. In other words, just on the coupon alone, you're making 45% return. And in a year and a half later, the company redeemed it at 100 cents on a dollar. So that was a big hit. So you can see Benjamin Graham principles works even on fixed income securities. So next one, you can see even the equity portfolio. So this is the equity portfolio, and this is the whole portfolio. And I was, again, lucky, COVID hit, and a lot of stock went down, and I was able to purchase some of them. And you can see in my portfolio here, they're not just the crappiest company, and they're not the best companies, and they're all over the place. And you can see they all worked out really well because when I bought them at a price lower than what the intrinsic value is. So Benjamin Graham principle applies, whether you buy good companies or crappy companies. And you can see, for example, about Alphabet, my cost was $2 million. And at the end of that first quarter of 2021, it was like 11 million. Then I've got junk, like Resolute Forest products. I bought it at 2.2 million. And at the end of the quarter was 10.5 million. So principles really work, right? So this is the portfolio as of 2025, end of the quarter, and you can see that the portfolio has done really well over that period of time, over the last 4 or 5 period. Alphabet has gone up, close to 10 times, and Berkshire Hathaway has gone up, more than double, and Apple has gone up, more than 6 times, right, and so on and so forth. And some of them are good companies, and some of them are, crappy companies. So, yeah. So, the thing is not to laugh at crappy companies. They can make a lot of money for you as long as you buy them cheap, right? So, yeah. And so what's the result of this? So let's look at Stonetrust book value. So next one is the page for Stonetrust book value. So in 2018, the book value was $64 million. And so you can see at the end of 2025, if you add back all the dividend that they paid, the book value would have grown to $214 million. So that has done well. On 2 accounts is because the portfolio has done really well, fixed income and the stock portfolio, plus operationally we have done really well. So that combination alone has pulled book value up substantially from $64 million to $214 million. So a lot of the people think you can just go and invest. You buy an insurance company, and then you can just go and invest. It's not as easy as that. When you buy an insurance company, you have to make sure it's really conservative. Now, if it is not conservative, and there are a few people that tried doing it the Buffett way, and they're concentrating on top line growth, and they don't care about proper reserving, conservative reserving. If you do that, the stuff that I did here, like buying the equity and buying the fixed income, you will not be allowed to do that. When you buy like junk bonds, like I do, and when you buy securities, equity securities, there's a charge to it, like 50% charge to capital. And so what happens is if you're running a junky insurance companies, you get limited to just buying T-bills. That's the only way you can get around it. And therefore, it is imperative that whoever is trying this trick, like something doing what Buffett is doing or Fairfax is doing, to have really conservative reserving policy. Like in Stonetrust, people are amazed. Normally when you put a reserve is an estimation of future liabilities, and you put it at the 50% confidence level, like somewhere halfway. Let's say the reserves are between 80 million and 120 million, you would put it at 100 million. That's what most companies do. I put it at a 95% confidence level. So if the reserves are between 80 and 120, I put it at $115 million. So in the short term, your shareholders' equity is not as high as it should be, but it gives me that cushion in case something goes wrong with it. I have the reserve that I could release it sometime in the future. So it's really important to be really conservative when you have an insurance company. So next one is, it was June in 2022, and I was looking at Florida, and I was wondering, what could I do there? Companies are going bankrupt. So you can see on this one, and there were legislative reasons, and because of that, so many companies couldn't make money. So 6 companies went bankrupt, and I believe 30 more were put on a watch list. And so biggest problem there was the litigation nightmare. As you know, in 2022, there was something called one-way, legal fees. So it was always the insurance company that would pay for it, one way or the other. They would pay for it. The other person that sued didn't have to pay for it. And so most of the losses came from there. The second one was Hurricane Ian hit, and it caused $25 to $65 billion of losses. And so the insurance companies were going bankrupt left and right. And then the only alternative for Florida was to create a state insurer that they would take up these insurance policies, because private insurance companies could not do that. So when I saw that, with all these calamities happening around it, I knew something positive would happen. You need something like this to happen for the Florida market, insurance market, to get mispriced. And so I was looking around. And to see if I could form an insurance company. But I needed something else before I could form it. I needed a sense that the legislative stuff would change. And so we formed the Loggerhead on December 1st of 2022. And just 2 weeks later, the legislative changes came. So they limited, they limited the one-way legal fees. And they also limited the other one that was really important, called assignment of benefits. So how assignment of benefits work and how it was corrupted was, after a light rain, a guy would come knocking on your door and saying, let me check your roof. I can get you a brand new roof. And, just wear and tear. And as long as the guy signed it, the assignment of benefits, that is, whatever rewards they get not through the judicial system, it would go to this guy. But the owner of that house would get a brand new roof. So normally, when you're fixing the roof, if it's an old roof, even if you fix it, it costs between $10,000 and $15,000, let's say, for a normal house. But when it went to the lawyers, it would jump to between $30,000 to $45,000, and that is how they would make money. So this guy would go to this house and make that pitch. Then he would go to every house in that neighborhood and make that pitch. And so that's the reason why this clause had to be removed. And luckily, in middle of December 2022, that thing was removed. And so our timing was really good. We went in on December 1st. By December 15th, the legislature made all these changes. So that means I have the tailwind behind it. So next question was, okay, I want to go to Florida. But what type of corporate format do you want? So in this format, we decided to go on something called a reciprocal. So the reciprocal is sometimes, they use all these big insurance terms just to impress people that are not insurance related, people that are non-insurance. And so a reciprocal, just think about it as an insurance company there. And then we have something called an attorney-in-fact. An attorney-in-fact is the management company. So we set it up like that. We have a management company that would manage the insurance company, and we would take fees, and the fees are 20% of gross written premium. And then who's going to fund the reciprocal? So the reciprocal would be funded through surplus note and subscribers' contribution. So surplus contribution means, let's say you have a insurance policy and you're paying $2,000, right, for your car insurance, and let's say you're covered up to $2 million. Out of that $2,000 for your premium, 10% of that is $200. That is members' contribution, and that goes to shareholders' equity. And now this is really powerful because it's not subject to premium tax, it's not subject to income tax. It flows right away to shareholders' equity. So that is the format we had. So we put in $10 million for 100% of the company. We put in $9 million to get 90% of the company. So just $9 million. But to make it easier, just use $10 million. So this was the format, right? So you can see, in 2024, our gross written premium was $163 million. That is from scratch. Our surplus was $53 million. But if you look at 2025, this year, gross written premium went up to $204 million, and surplus went up to $73 million. And one of the things that really helped us is because a lot of companies were leaving Florida, and when you leave Florida, you just cannot leave. You have to have something for the policyholders. So Progressive was leaving, so we went to Progressive and said, if you leave, why don't you give the policy to us? And we will replace your policy with your, with your policyholders. So that's what we did, and that's why our premium were able to grow so rapidly. So And so question is, now LRM is Loggerhead Risk Management, and that is the management company. And remember, we put in $10 million to have 90% of the company. But look at what happened in 2025. They made $18 million, 18.3. No, on a $10 million investment. And we expect to make somewhere around $20 million for the next 5 years, $20 million or more. And you know why this 18 million is so important and it's so critical, and why why it is so different from other companies. A lot of companies can say, okay, I'm making this $18 million, but you have to put it in inventories. You have to buy more fixed assets, more into receivables, and so on and so forth. This $18 million that LRM is making is pure cash. They can just throw it out. It is pre-tax, and they just can throw it out to shareholders. And that is what they're doing right now. So if you go to, let me go to the next slide. So you can see on this next slide, there are two things I would want to talk to you. First was the members' contribution, right? So you can see members' contribution in 2025 was $29 million. Now, Loggerhead has gross premium of $200 million. So 10% of $200 million is $20 million. And you can see out of that total surplus, in insurance, when we say surplus, that's equivalent to shareholders' equity. And you can see if you go through the years, like members' contribution as part of that surplus is growing because of that $20 million being added every year. So 2026, we expect members' contribution to be $50.2 million out of $81 million in surplus. And by the time it comes to 2028, it would be $93 million. Out of a surplus of $105 million. So that is really critical. This members' contribution is contributing to, to the growth in surplus. And that allows you to write more premium if you want to. And next one is the distribution of dividends. And this is where I'm saying the quality of earnings for LRM. So they made $18 million. And you can see in 2025, they threw out almost $13 million in dividends. They don't need it. So for the 2026, I just put in $15 million because I was under pressure from Professor George. I have to complete my slides. So I just put in 15. Otherwise, Professor George said, I cannot be a presenter here today. So, but what happened was just last week, they gave me $8.2 million in dividends. And then I was told that, and then I was told a few weeks from now, maybe in late April or early May, I would get another $8 million in distribution. So don't you think that's so powerful? Just cash coming in. So if you look at it over the next, 5 years, at this holding company, we have this holding company. We had cash of zero, a year ago. In 5 years from now, we'll have close to $90 to $100 million in cash. Now, the question is, how much would you put a valuation on a company like LRM, which is a management company? So if you think about the S&P 500, right, it's selling at 30 times after-tax earnings. So if you take LRM's earnings, let's say $20 million, and you put a 30%, let's say, a tax on it, so it's making like $14 million, right, after tax. So what is 30 times 14? That's more than $400 million. Like I would take it just for $250 or $300 million. So just to show the power of, what Loggerhead has been able to do in terms of enhancing the intrinsic value, of Vintai Holdings. Vintai Holdings is the parent company of Stonetrust and Loggerhead. And if you go back here, right? If I go back here, so see if you on this slide in 2018 it was $64 million. Now, if you add up what Loggerhead is, let's say $300 million plus $200 million, for Stonetrust, that's $500 million US dollars that we have grown from $64 million, and that too done in a way that's not highly risky. We were not gunning for premiums, and we are not gunning, our policies on everything is highly conservative. And we did it, in a really safe manner. Okay, so this was so this is a reinsurance opportunity. Now, as you know, I'm all the time hunting for bargains, hunting for mispriced opportunity, whether it's in the stock market, bond market, or insurance. So I was looking at, we already have Loggerhead, and we have, Stonetrust. Where else are the opportunity? So I normally get all these contracts. I look at them, and then I was surprised at some of the pricing in the reinsurance market. So let me. I know some of these terminology are a little bit complicated because I'm going to use some insurance language. So I got this something called reinsurance contracts. I look at them, and so I look at this. We have layers, like excess of loss reinsurance. And reinsurance means insurance companies are buying insurance. And that's why we call it reinsurance. So I was looking at, event, and occurrence event, like 1 in 10 years. And so the first layer here that I'm showing it to you is 14 million in excess of $10 million. In other words, if I go into this layer, I would take losses from between 10 and $24 million, right? So I would take a loss of $14 million between 10 and 24. And then I was looking at it, what should the pricing be? So I was saying, okay, if I take a $14 million hit, and that's going to happen 1 in 10 years, then if I divide 14 by 10, to get at a break-even price should be 1.4 million. But you know where the pricing was for this layer? It was at 110%. Instead of 1.4 million, the pricing was $15.4 million. Now you cannot go wrong with it. You just have to hold on long enough. So I said, this is definitely a big mispricing in this reinsurance sector, and we should get into it. So last year, I formed a reinsurance company called WinRe, and just to exploit this opportunity. And not only on this layer, 1 in 10 years, you can go in 1 in 50 years was the same kind of mispricing. So I had a choice. I could go into any layers. I could go into layers like 1 in 250 years, 1 in 100 years, or 1 in 150 years, and I could get a really good return. And my risk, if I stay long enough for that 10-year period, I would really be safe, right? So I was really shocked, and so what I did was, so I formed a company called WinRe just to go into reinsurance, and that was last year, sometime in March or April, that I started to get money in. And then when you start a company brand new, but you would expect a $5 million loss. It's really hard to do it right off the bat because we had nothing structured. And then we were under pressure because, you have to get you have to accept the contracts by May 1st, some of these excess of loss, and some of them are June 1st. But we were able to do it in a really short order. Like, we were able to get the approval from Cayman Islands in 45 days. We registered it in Cayman Islands because you don't have to pay taxes. And so the results just came in, so we made, we raised $34 million out of 41 shareholders, and we made over $10 million, over 30% return on equity. And you can see, and so this is the beauty of Ben Graham. You can apply it in so many different fields. You can apply it in insurance. You can apply it in fixed income. You can apply it in stocks, and even in stocks, you can apply it. You can indulge in the taste. Whether you want good companies or bad companies or companies going bankrupt. And as long as you buy them cheap, you would do really well. So this is what I wanted to bring it to your attention, that what I have done here is just basically following pricing, very similar to what Benjamin Graham would do, looking for mispricing, looking for if it is undervalued, and then to go in. And then, good things will happen. As long as you don't do it just for one contract, if you do it over, several contracts, and then you have enough diversification. And so Professor George asked me, and I said, could I share this result with your audience? And he said, yes. So I was really happy to come here and show you what we were able to do in that short period of time.